I am joined once again by Harris Kupperman. Everyone knows him as Kuppy, an investor and founder and chief investment officer of Praetorian Capital. Kuppy, welcome back. How are you doing?
I'm doing great. Thanks for having me on.
It's my pleasure. What do you make of the tremendous turmoil in specific regional banking, regional banks, as well as banking stocks, which are going up and down and extremely volatile? What are your first level thoughts?
Well, I mean, in terms of the bank stocks themselves, I mean, they're just reacting to the news of who's, failing and who's getting, runs in the bank. And I think this is all, really quite predictable. But in the end, I don't think this is like 2008. This isn't, a great financial crisis. Maybe it'll lead to something bigger in the future. But what's going on right now is you have, the banks that lent to Ponzi schemes, like, of course, it was going to fail. And you have the bank that, banked all the crypto coins, like, of course, it's going to fail. It's all like relatively obvious. And, I think it's interesting today where, the Fed kind of stepped in and said, okay, we took down the banks that, were bad actors here. And now let's, draw a line and say, like, these banks here deserve to exist.
Mm-hmm.
We're going to, move some things around and kind of ignore some rules we have. And we're going to make sure that some of these other banks that are a bit wobbly exist. And I think that's probably the right thing to do. You don't really want to have a panic. You just kind of want to get rid of the bad actors that were doing, dumb things. Banks are meant for, storing deposits and lending. They're not there to, prop up dog walking apps.
And let's talk about the deposit side, the liabilities of the bank, which are pulled extraordinarily quickly. Bank runs have existed for a very long time, but there's something about the nature of all these venture capitalists pulling all of their money within just a few hours that the FDIC took it down in the middle of the day, not after market close, which I think it likes to do. Do you think there's something different psychologically about everyone's online, everyone following the news so quickly that bank runs are maybe more prone to happen?
Well, I think when you look at a Silicon Valley Bank, you really had a couple of large VC groups that are all friends with each other. And they told all their portfolio companies, hundreds of companies, like, get your money out before the other guy does. And so it cascaded really fast. I mean, like, look, if my bank here had a bank run, I'd have to actually go to the bank and do something. It's very different. And, I don't really keep that much money at the bank, so it wouldn't be worth the effort of standing in line to do something. And so I think it's just built different in a way, because you only have a couple of, portfolio managers of these VC groups. I mean, I think it's really interesting to look at. In 1907, there was a bank run, and JP Morgan got a couple of his drinking buddies together, and they said, we're going to stop this bank run, because we, want to, but this is before we had a Federal Reserve, this bank run's bad for our business. And, you fast forward 100 years and the Silicon Valley guys say, let's have a bank run. Let's really get the money out as fast as we can. And I'm going to tweet as we're, withdrawing the money. I'm going to tweet to all my friends, like, you guys need to go faster. JP Morgan, wanted to build something up, and Silicon Valley couldn't care less. I think it's cultural as much as it is technological.
The emergency measures enacted by FDIC, Federal Deposit Insurance Corporation, Treasury, and the Federal Reserve on Sunday. By the way, we're recording this on Thursday, March 16th. Those emergency measures passed on Sunday. How effective do you think they will be in preventing future bank panics? And the question number two, was it a bailout?
So bank panics only happen when people lose faith in their bank. I'm not particularly worried about my bank. I've dealt with my bank for a long time. They're kind of like too incompetent to fail. I'm just not that worried. So I'm not getting in line. Plus, it takes effort. I think you need to really be worried. I think, Silicon Valley Bank failed because a lot of people know what the bank's lending money on, and they were really scared about it. SBNY failed because people knew what was in there, and they got really scared. I think you can pass as many laws as you want and move the pieces around the chessboard. When people think their bank is a house of cards, they're going to get their money back. And people don't want to, even if you are told, yes, you're going to get 100 cents on the dollar back, no one wants to, deal with the paperwork and, I got to do this, I got to do this other thing. Like it takes effort. It's just easier to give your money to a too big to fail bank or bank with someone that's an adult. And so I don't think there's ever going to be able to stop bank runs. I mean, the history of bank runs is that these things happen. I mean, the Federal Reserve was set up specifically to avoid this problem, and it still happens. So I don't think it's going to succeed in what they're looking to do in terms of a bailout. Yeah, of course it's a bailout. But it's a weird sort of bailout in that, the money goes from here to here, to this guy's pocket, to that guy's pocket. And then in the end, there's a tax on the banks that did the right thing, that, didn't do illegal things and didn't do crazy things. And I'd be really upset if I was a regional bank that ran a conservative business and suddenly I have to pay for someone else's sins. I mean, that's called communism.
Kuppy, you've been known to be a value investor who likes to buy bargains when they fall sharply in value. We've had a lot of stocks go on sale on Monday. I won't name the names of people who are following this. They know what I'm talking about, where they were trading 80, 90, 95% of where they were a month ago. Are any of those stocks a sector that you think you might get into? And if the answer is yes, is it an investment or a quick trade?
You mean in terms of banking stocks, or in terms of all
banking
things?
Banking stocks.
No, because I don't think they're good investments. I mean, we've traded them before, and there's a lot of fear. You step in front of the freight train, and occasionally you get nailed, and usually you make money, and it's a probabilities thing. And we'll see how it all works out. But we've put some positions on, but they're not particularly large positions. I don't want to name names, but when there's a burning building and everyone's running out, I'm usually the idiot running in. Like, over my career, it's mostly worked, though. I've got some battle scars. So we did a bit of that, but no, I don't think these are actually particularly good businesses to be in. I mean, banks are highly regulated, low return on capital businesses. I mean, it's kind of like the post office, and these companies have, like, it was a freewheeling time before the GFC, and these companies found creative ways to make a lot of money. And then it turned out that a lot of the money they made was fake, and a lot of them went bankrupt. And the government stepped in and put a bunch of rules in place. And it's much harder to make money now. And so you have these bureaucratic organizations with a lot of regulation and a lot of paperwork to earn, if you're really good at this, kind of a low teens return on equity. I think you can do better in much other places, particularly because these things have this combustibility to them that adds a lot of risk for not enough upside.
Right. So that's on the investment case. But when a stock collapses in value, there's a chance the panic is overblown and it's not as bad as people think. There's a chance that the panic is accurate and it's at fair value, or there's a chance that actually the stock should be down a lot more. What's your general sense on the sort of troubled banking stocks?
I think it's all going to go lower. I mean, we're at phase one of this crisis where some guys wired some money out, and a bunch of banks almost failed because people wanted their money back. I mean, phase two of the crisis is when interest rates are higher and people can't refinance their commercial real estate. I mean, you've got a bunch of office buildings that are going to be empty. Like, who's paying the mortgage? Who's paying the rent? Who's going to pay the mortgage? And then you go to refinance these things, and interest rates are a couple hundred bips higher. I think a lot of people are going to mail their keys in. I mean, it's not going to be like the GFC where all of a sudden the music stops. I think you have a multi-year period of, adjustments to loans and, extend and pretend, and guys are going to go on interest only, and all sorts of things that get moved around to buy time. But eventually, I think a lot of these, properties are going to send the keys back to the lender. You can only buy so much time, but if you underwrote this thing at a 3 cap and you financed it at 2 in 2019, and suddenly it's at 8 cap, you're financing at 6, like that 6 financing on a 3 of cash, like it doesn't work. Like, the owner has to, when it goes to refi, the owner has to put more equity in, you have to do a giant debt pay down. Like, you can extend and pretend a little, but I think a lot of these banks are going to suffer because, they still have to pay out the depositors at much higher rates going forward. And I think a lot of this crisis is caused by the fact that these banks never really paid, for over a decade, they never really paid the depositors anything in terms of deposit fees. And so when people said, hey, I can make 4% in a money market, I don't need this bank anymore, like the business model died. And, I think these banks could have paid the depositors a lot more in terms of their checking account, and they probably wouldn't have the runs on the bank, as they started. But then the business model doesn't work because they were probably lending out at less than 4. So no, I think a lot of these things are just going to be miserable investments where they just stumble along with a lot of equity raised and a lot of problems. It seems like a terrible place to put your money.
Right. And there's a saying about banks, I'm sure you've heard it many times, that rising rates are good for banks. High interest rates are good for banks. Is that true?
Yeah, it's true to a point, and there's a tipping point. If you raise interest rates 100 or 200 bips, yeah, you over a couple of year period, you get paid. You have some floating asset on the bank balance sheet, so that gets paid more almost instantly, and the depositors only slowly adjust to their expectations, and no one really gets into financial trouble because what's 100 or 200 bips, and it's a slow process. When you have the fastest rate hiking cycle that we've had, like, stuff's going to break and it's not going to work. And I think we've hit that tipping point because we've learned that a bunch of banks that were thinly capitalized can't take what happens when interest rates go up, because their bonds go down and their equity goes poof. And so we just had that happen. When it goes slow, it's much better. If you look at say Japan, where they're slowly raising rates, like it's going to be incrementally better, mainly just because it was so miserable for so long. But no, I don't. I think past a point it doesn't work.
Right. Yeah. Japan it's very slow. I don't know if it's possible to be slower than Japan.
I think in Japan they're going to go. They're going to do 25, and then they'll stop for a bit, and they'll do another 25, and it'll be like adding oxygen to these banks that have had literally just no earning capacity for over a decade. And I think that's an intelligent way to do it. If that's a good place for a bank to be. It doesn't mean it's good for the Japanese monetary experiments.
Right. So you don't think this is the great financial crisis. You don't think it's going to be a series of dominoes. That being said, you don't think the banks are a good business model. So you're somewhere in between there. What are your thoughts on the impact of this banking turmoil on the market and the economy? The Federal Reserve, I think the Federal Reserve going to pivot sooner than it was if there was no banking crisis. Are interest rates going to be lower? Are banks going to lend less and inflation is going to be lower? What are the knock-on effects of this turmoil?
I don't think there's going to be much in the way of effects. Look, you had the shitcoin bank, they went out of business, and another shitcoin bank went out of business. Then the dog walking app bank went out of business. And then, the Fed drew a line in the sand, and, they moved the pieces around. And in 2 weeks, we'll be on to some other problem. I don't think anything's going to change. I wish something was going to change, because, when something changes, and as an inflection investor, when stuff changes, there's opportunity. But I just don't see it really. I think incrementally, very little changes. I think banks are going to keep lending. I think interest rates are likely to stay high. And as a result, banks need to replace a lot of their low earning assets with higher earning assets. And as a result, they're going to be much more incentivized to make loans and grow the yield of their portfolio. And so I think the net result is probably going to be reasonably good for the economy. I have this very different view than a lot of people do in terms of interest rates. I think 0% interest rate is very deflationary because banks don't want to lend because you don't get paid for it. And I think raising interest rates is actually highly inflationary because banks are much more incentivized to lend, and that grows the money supply and it grows economic activity. And I think it's going to be really good for the economy if they keep raising rates. And of course, if you're commercial real estate, that's terrible for you. But the economy is more than private equity and commercial real estate.
Right. So you don't think it will affect how high the Federal Reserve would hike to, because a week and a half ago, the market thought it would get to 5.6%, whereas now the market thinks, we're going to get cuts this year. So there's been a kind of a huge panic in the bond market.
It's been one of the biggest moves in rates in my career in terms of, what's just happened on a 2-year. Maybe they're right, maybe they're not. I think the Federal Reserve historically is, continued going until they break something. And I just don't know if the crypto bank is, a something. I think they're going to keep going until something actually breaks. But as you see things sort of like fraying around the edges, they're probably not too many hikes away from actually breaking something real. And that's at the point where they take a pause and maybe drop rates. I don't know. We'll have to play it out. But thus far, I don't think anything's really changed. I mean, I think they've been pretty clear they're going to do 25s and keep doing 25s till they break stuff.
Hey there, sorry to interrupt. A lot of forward guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some forward guidance listeners are into crypto. Some own crypto, a smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. Things have broken, but nothing systemically important in your view has broken yet. Business as usual. Where does that lead you as an investor? Where are you finding bargains, things that are attractive? We know it's not in the banking sector. Where is it?
Well, let's look at the other thing that dropped. Oil dropped precipitously. A week ago, oil, and I'm talking about West Texas, was just over 80, and we got down to 65 yesterday at the depth of the crisis. I mean, that's a 20% move in 5 trading days. Like, if the price of oil drops, the price of everything touching oil has dropped, even more, because it's, levered to what happens in oil. And I think these things are great investments. I think you had a situation where a bunch of hedge funds were long oil on one side and long, some sort of interest rate derivative on the other. And 2 years moved, and they got a margin call, so they sold their oil. And it's the history of hedge funds is kind of funny, because if you told me that the business strategy was, when the price goes down, you sell it. When it goes down more, you sell more of it. And if it goes up, you buy more of it. I'd say that's really stupid. You want to buy low and sell high, but these guys make all the fees. So I don't really know. I mean, I think they're more of a marketing business than investors. But I think these guys got into trouble, and we've heard of a couple of hedge funds that massively degrossed, that suffered pretty egregious losses, and they sold their oil, and the price dropped $15 in a week. And I think that's where all the opportunity is. I mean, the global economy is very strong. China is reopening. India, a bunch of Asia is just booming. And I think the demand for oil is going to grow quite a lot this year, probably way more than most people are estimating. And on the supply side, I don't see much growth. I mean, in the U.S., we already have rigs getting put down, where the rig count's declining. You don't see a lot of capital expenditure. Since 2014, there really hasn't been much expenditure. I mean, if demand grows 2 million barrels this year, like, where does the supply come from? If anything, you're going to see supply flatline, give or take a little. And I just think you're going to see quite a lot of demand growth. I think the deficit, which was reasonably large last year, is just going to expand. Of course, you had this offset of China kind of locking down for 6 months. So all the numbers look kind of messy, and I think it's messing with people's analysis. But I think by the second half of the year, you're going to have really sizable deficits, and it should be really good for energy prices. And when you look around the world, everyone's been complaining about inflation, but here at $65 oil, that seems like the only asset that hasn't inflated in a while. It really hasn't moved. I mean, it's in a range, but I mean, $65 oil, that was like 2005, and just think of all the inflation we've had since then. And as an investor, you buy the thing that's really cheap. And, at $65 oil, a lot of the marginal producers aren't even economic anymore. And that's why they're going to stop drilling. And if you don't produce more of it, the price goes up. So no, that's what I've been focusing on.
Right. So we have oil in April of 2020 going from less than zero, negative prices, to, I think, June of 2022, over $120. And it's gone from $120 from the summer of last year to now, as you say, less than $70. What was the supply demand picture then when it was at $120? What is the supply demand picture now? And to what degree does that change in the supply demand picture explain the fall in price? Or do you say, hey, actually the supply and demand indicates the price should be higher, but it hasn't? What do you think?
So when it got to 120, clearly there was more demand than supply. And, there's a bunch of different acronyms that publish data and they all kind of disagree with each other. And, I don't think it's possible to really say within 1 million or 2 million barrels what the actual number is. So I don't really focus on that. I focus more on what's changed since the baseline. So let's look at the summer of last year when oil was 120. What's changed since the baseline? China locked down. They locked down for, let's call it 150 days and 3 million barrels were offline. Like we're talking about like 450,000 barrels, 450 million barrels. You have the US dumping almost 250 million barrels of oil. You have the winter here being quite warm, so a lot less heating oil demand. I mean, you start adding up, bits and pieces here and there, and you're looking at a 1 billion barrel change in the second half of the year last year in terms of, less oil consumption. And as a result, the price, of course, it dropped, and then they told Russia that they couldn't get, the market price. The Russians had to sell at a discount, and then the Europeans completely cut them off. So they had to sell to India. I mean, the Russians aren't stupid. They said, here's the deadline. We're going to dump all the oil we can. And so they dumped 100 million barrels, and then they did another 100 million barrels of refined product, or whatever the exact numbers are. No one will ever know, but it's somewhere in the 100 to 200 million barrels combined that they dumped of their inventory. And so the world was swimming in oil around Christmas time, and we're chewing through it now. And I think in Q1 we're probably going to be roughly balanced, maybe a slight surplus. And then I think by Q2, as China reopens and jet demand grows and all these other things reverse, we have a bit more SPR release here in the US. We got to trudge through. But as these things kind of reverse, I think incrementally each month, the deficit's going to get larger, and expanding deficits make the price go up. And I think we're kind of right at the nadir here. And it seems so fitting that all the hedge funds sold below. They do every time.
When you said America was putting barrels on the market, you were referring that we were, Biden administration releasing barrels from the SPR, Strategic Petroleum Reserve. How
Correct.
big of a factor do you think that was in keeping the price of oil down, or causing the price to go down? And yeah, I mean, do you expect, I know there was a time where they said above a certain price, we're going to release from the reserve. Below a certain price, we'll actually be net buyers. I think it was maybe $68. The price of oil, I think, is below that now. And is Biden doing an oil buyback?
Of course not. They're not buying any oil. They might do some token barrels, but they're really not going to buy. But in terms of, did it matter? Of course it mattered. If you drop 1 million barrels a day on the market, and then China goes offline for another 2 to 3 million barrels a day, like that's 3 to 4 million barrels. That's a lot of barrels. It's going to swing it from a decently large deficit to a smallish surplus. And as that reverses, I think you end up ending this year in the 4 to 5 million barrels a day deficit range. And I don't know if China plans to lock down again, but it's kind of crazy they did it the first time. So they probably won't do it the second time. And if the US is kind of out of oil to dump, like where does that oil come from? At some point, you have to actually drill for it. I mean, that's where oil comes from. And like I said, I mean, the rig count's declining. No one's drilling. So no, I think you're set up for oil to have a pretty crazy move. And yeah, I mean, I think people look at oil and they think of these things going in linear lines. It goes from this price, it just keeps going and going. That's not how commodities act. They get priced on the marginal barrel. Oil is a very political commodity, the seasonality to it. I think it's doing exactly what you'd expect it to do during a multi-year bull market. It overshot to the upside. It destroyed a little bit of demand. Politicians meddled and they found some supply, and the price got dropped, and then people stopped producing as much. So it's going to go back up, and it's just going to, kind of do a sine curve, but, kind of inflecting higher. And I think it's doing exactly what I expected it to do. I'm a little bit surprised at the amplitude of the moves, but, I would have thought it would have been, a little bit less whipsawy, but it is what it is.
So do you think the marginal barrel of demand is now coming from China?
Of course. I mean, there's over 1 billion of them. And yeah. I mean, I think people lose track of the fact, because I travel a lot. That's like really my hobby. There's 6 billion people on this earth who, most of them don't have refrigerators. They don't have washing machines. They don't have cars. I mean, they don't have electricity. or barely have any electricity. And, those people want the same standard of living that we have and on a per capita basis. And I believe in human progress. And I believe that these people will figure out in my lifetime how to have a similar standard of living. And, when you think of how much energy gets consumed as that process happens, it's kind of mind numbing because, we barely can produce enough energy for just the billion or so of us that have a first world standard of living. And I just think the demand for energy is insatiable and it's got to come from somewhere. And as a result, as this progress in GDP growth globally, the demand just grows every year.
What have you made of the spectacular rise and fall and insane volatility of natural gas?
It's called the widowmaker for a reason. Natural gas trades on what happens in the weather. And despite a lot of people thinking they could predict the weather, no one really knows. And as a result, it's insanely volatile. And I don't trade it because it's crazy. There's things that I think you could predict, and predicting if it's going to be cold next week is not one of them. So, no, I mean, there's people who trade this and make and lose absolute fortunes. And it seems like almost every year some hedge fund blows up short. And that's just part of the game called nat gas. But for me, nat gas is really just it's a byproduct of oil production. And, it's a reason that I think the U.S. will see a lot more industrial activity than a lot of other places, just because we're, unusually blessed with this cheap nat gas. But it's going to be crazy volatile, and, good luck trading it.
Kuppy, I know you were in favor of expressing your bullish view on oil by direct exposure to the commodity itself with futures and options. And you were in favor of that over their perhaps more conventional play of buying oil producers, pipeline companies. Is your thesis still the same, or has it evolved at all?
There's been a bit of evolution, but for the most part, look, the way you fix an energy crisis, and we're about to have an energy crisis, is you spend hundreds of billions of dollars incrementally each year looking for oil and producing oil. And I'd much rather own the companies that are going to be beneficiaries of all this spending, especially because those companies have really been crushed during the 7-year bear market where there wasn't much spending. And you could buy those companies at fractions of replacement cost. And I think they're going to really earn a ton of money. Whereas I think a lot of the producers are at risk of geopolitics, where the price of oil goes up and politicians say, let's do an excess profits tax, let's do a carbon tax, let's, hurt these guys. And as a result, I think the profitability might get impaired. I think you take a lot of risk. And, we've seen the UK do this. And if the UK can do it, the US can also. And, it's a scarier place to invest. And, that's the reason I just own I mostly just own the futures, and I own futures options, and I own some of the services companies. But I have recently bought one producer, and it's kind of odd for me to be buying a producer because I'm not really big fans of producers. My experience with producers is they take your money and they, drill for buried treasure. And I don't want them taking my money and looking for buried treasure. I found most oil executives to really be focused on how much oil they're producing. I guess they go to the country club and they get to brag to their friends how much oil they're producing, when they should be bragging about how much money they're producing. And it's just like a weird mentality amongst these oil guys that they just want to, drill holes all over the place. And often they don't even ask if the holes are profitable. And so I've really hidden from investing in producers. The last time I seriously looked at a producer was a company called Sandridge. And at the time you could buy it for about $1, and they had $2 a share of cash. And it was profitable. And, you got to have this free look at if energy prices recovered in the summer of 2020, you're going to make a lot of money. And, I told everyone I knew about it to go buy some, and no one really wanted to talk about energy stocks. And stock went from $1. I mean, it went past $20. Like we sold too soon, because we always sell too soon, but it was really great for us. And I think you have a similar situation now with this company called Journey Energy, which is listed in Canada. The ticker symbol is JOY. And my main reason for investing in it is that I like the guy running it. He's previously built 2 other companies by acquiring assets, often distressed assets. He's kind of a value investor. He's not buying the A+ oil assets. He's not buying, Permian acreage and drilling holes. He's buying older assets that are low decline. He's trying to improve the operations, but he's buying these things very cheaply as a value investor. And he's using financial leverage, issuing a few shares. And if you look back in history, if you buy low decline assets at periods of time where the price of oil drops, and then the price of oil goes up, you make a lot of money. And these sort of roll-up strategies are amazingly successful. It's what everyone should be doing in the energy patch. It's what private guys do, but public guys, just for whatever reason, want to look for buried treasure instead. And I think he's doing what the right business strategy is: of produce cash flow, buy more oil assets, and not drill too much. You drill a little to keep the production going, but you're mainly focused on just consolidating assets. And going back to what we talked about a few minutes ago. Price of oil goes up, price of oil goes down, it goes up to a new high, it goes down again. Like, this is the oil cycle. And what's interesting about the oil cycle is that oil guys like to borrow money and drill holes. And so a lot of guys borrowed a lot of money at 120 and drilled holes, and suddenly oil's 65. They're probably in financial trouble. And if I think the business plan, as I see it at Journey, is that Alex, the CEO, he's going to now use his cash flow to buy one of these guys in trouble, and he's going to acquire it very, very cheaply at a time when other guys are really focused on their dividends and their buybacks and drilling their holes. He's just going to buy these guys to get in trouble. And as you look at this sine curve, and there's a sine curve on the way up, at the bottom of each of these cycles, he's going to buy someone, and then on the way up, he's going to earn a lot of cash flow, pay off the debt, and do it again. And if you have low decline assets, it's just a really profitable strategy. So in conclusion, we bought a lot of shares, and we own a couple percent of the company. So I'm talking my book here.
I've found that sometimes when people talk about valuations of oil companies, they say it's trading at 6 times earnings or 6 times free cash flow. But when they talk about earnings, they don't include the cost that they have to reinvest in the business, which in oil fracking is huge. And then for free cash flow, they don't include the debt. How do you value something like Journey? What is a multiple? Is it a free cash flow, net income? Do you think a different multiple? And then at what price of oil does Journey, start breaking even? At what price does it start making a lot of money? And at what price of oil is it unprofitable? Because I know with ExxonMobil, it needs 30, 40 barrels a dollar break even. Some fracking companies, in 2014 needed $90 barrel oil. And I know maybe the economics have improved a little bit, but yeah, tell me a little bit about how you value Journey Energy.
So I think the simplest way to value an oil company is looking at a metric called PDP. That's you're producing wells and what you expect to get out of these wells over the life of the wells at a reasonably high discount rate, using the current strip and using basically your current costs. It's basically, how much cash do you expect to get out, and then how much you have to put in to get that cash out of the stuff that's already producing. So you don't have much capital expenditure, you've already spent the money, and then you discount it back. And I think it's a really good starting point because you can normalize lots of energy assets on this PDP metric. I mean, I don't think cash flow is a useful metric in any way, because a lot of that cash just goes right back into the ground. It's not your cash. I mean, if you don't put it back in the ground, you don't really have an oil field, in a couple of years. And, that cash flow number also is very tied to the price of oil. And so you'll go from making money to losing money to making money. It's a kind of dumb metric. I mean, the best metric is just PDP. And then usually from that PDP, you can adjust it at various oil prices. You plug in the oil price, you can say, hey, this is what, the price goes up $10, well, the PDP value goes up. And that, that's kind of like your snowball, and every time you drill a well, it's like you grab a handful of snow and you stick it on the snowball. And, the snowball might, as you move it around, you might lose a little, you add some, but that's your snowball, and you're hoping it just gets bigger over time. And I think it's the best way to think about it. An oil company with Journey, it's trading at about half of PDP, which is quite cheap. Most oil companies trade at a premium to PDP. I think the company's, it's a smallish company in Canada. It's kind of been misunderstood because if you own a lot of drill locations in the Permian, you can say, look, for the next 5 years, next 10 years, these are the drill economics. We're going to keep doing holes. And everyone says, okay, I have line of sight. I can build a model. With Journey, what you have is Alex saying, someone's going to get wounded. I don't know how big the check we have to write is. We might have to raise some equity. We might not, but we're going to do everything very accretive because I own a lot of shares. Alex owns a lot of shares. But it's a harder, more confusing story for Wall Street to build a model around. you basically have to spend some time with Alex on the phone and understand that he's done this twice and he knows what he's doing. In terms of the break evens, it's actually quite low. In Canada, you have sliding royalties. It protects you. I don't have the exact number, but it's pretty low. I'm not particularly worried, and they don't have much financial leverage either. So you don't have to worry about the debts and all that other stuff. Like they're in good shape.
Right. And also, are they acquiring, or did they just buy some sort of power plant?
Yeah, I guess necessity is the mother of invention. When power prices spiked in Alberta, they said, well, we have all this nat gas. We're not really getting paid well for our nat gas. Let's produce our own power. And then from there, they said, well, we're producing so much power. Let's go sell it to the Canadian power system. And then from there, they said, hey, this is a really good business. Let's do some more of this. And, it's going to end up being a business that has a lot of cash flow from the power gen assets. And, power gen is a lot more stable than oil and gas and nat gas prices. So, it deserves a higher multiple because of the stability and the reliability of it. And they could be producing nat gas for a very, very long time. So I think those assets will be quite valuable over time as they continue to basically buy up equipment and produce, electricity.
And then how do you think about hedges on oil? Some oil companies hedge 70% of their production, so they're protected on 70%. They lock it in at a certain price. Others are quite unhedged. Some no hedged. What's your philosophy on the matter? And what does Journey have with regards to hedges?
So Journey isn't hedged really. They have some nat gas hedges, which I think are rolling off very soon. In terms of hedges, look, if you're going to run a very levered book financially, you have to hedge. If you have low net debt, you don't need to hedge. I mean, hedging really, it cuts off your upside and protects your downside to a certain extent. But if you have the balance sheet that you can live through the shakeouts in oil, and there's always going to be shakeouts in oil, then you can ignore the hedges and not miss out on your upside, because when it gets above 100, you're making a lot of money. You don't really want to cut that off in any way. So no, Journey's been basically running unhedged. Though when the price of oil spikes up, they sometimes put some hedges on. But I think that's the right way to do it. When the price goes up, you lock some in, and when the price goes down, you do nothing. As opposed to this blanket approach of let's just hedge 25% for the next 5 years and just not really care what the price is. You've seen a lot of companies miss out on a lot of the upside this cycle.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present, because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. So your secular thesis is very long oil, very long energy, uranium as well. We haven't talked about, but opportunistically, what are you sort of seeing as attractive ways to deploy capital? And I'll give an example. I think last year, I don't know exactly when, but the stock market had gone down a lot, and speculative technology companies had gone down a lot in value. Which, by the way, our first interview in December of 2021. You said, I'm paraphrasing, that atrocious companies will continue to have a bear market. And you were right. They did up until June. But I think, I don't know, correct me on the timing, around that point, you wrote an article, I think it was called Renting Some Ponzi's. And you identified, these are not business models that I like, are long-term investing, but I'm seeing some opportunity here. So maybe you can talk about that, and are you having a similar thing where maybe this doesn't fit in with my long-term thesis, but this is an opportunity?
So I think as a trader, you trade what's moving. And I think you can hold your nose and buy frauds and Ponzi schemes and all other stuff. There's moments in time when financial conditions loosen and there's a lot of liquidity, and Ponzi schemes tend to do really well. And I think a lot of investors lie to themselves, and they pretend like they understand these and that they're real businesses because they build financial models, and they treat it like a real business when they should just say this is a Ponzi scheme run by criminals. But these criminals are really good at stock promotion, and we could ride this for a little bit, especially when you have regulators that have abdicated all responsibility for regulating the financial markets. And we had a moment like that. Well, we've had a couple of moments, but we had a moment in 2022 at the end of the summer. And you have to understand the hedge fund cycle, the pension fund cycle, which is that there's redemptions and they ask for their money back, and they tend to be at the end of June and a much bigger cycle at the end of December. And at the end of June, a lot of Ponzi schemes, very liquid, well-known Ponzi schemes, traded down dramatically. And I thought this was due to pension funds redeeming from the sort of hedge funds that own Ponzi schemes. And so we bought some Ponzi schemes, and I put out a blog post and I said, I think this is kind of the bottom in Ponzi schemes for a while. And Ponzi schemes stopped going down, and then people who were short had to cover, and they went up a lot. And in a month, 2 months, we made a lot of money long Ponzi schemes. And it's kind of embarrassing to say how much money we made because it's a lot, but we were long things that won't be around in a couple of years. I mean, some of them have already gone bankrupt. But I think you have a toolbox as an investor, and there's you reach in, you grab the right tool, and there's moments in time for almost every tool. And no one should ever say like I'm too proud or anything like that. Like you play with your toolbox.
What tools in the toolbox are you looking to grab right now?
I think cash is really good here. I think it's going to get really bad. People are bearish. I get that. I mean, the bull thesis right now on the markets is everyone's bearish, but sometimes everyone's just right. And if the Federal Reserve keeps telling you they plan to break stuff, well, I kind of take them at their word. They have a long history of breaking stuff, and maybe you should just be bearish. And we don't short. We don't short much. But what we do is we take our exposure down so that when something breaks, we have plenty of room on the balance sheet to buy stuff really cheap. And, I think people have been bearish for a year now, and it's been the right call. The market's, gone down. It's gone up a little, gone down. But I don't see what makes the market go up. And I can see a lot of things that make it go down. So it seems like a pretty terrible time to own businesses that aren't in the energy sector, because the energy sector is, kind of near the bottom of its cyclical cycle, whereas everything else is kind of in the second or third innings of its cycle on the way down. And so, no, I think the thing in the toolkit right now is just, running lower gross and waiting for opportunities. And I feel like there's way too many people in my industry who look at the world and they have this view that, oh, people are paying me fees, so we got to be long stuff. And, that's not always right. I mean, people pay you fees so you don't lose their money. Like, it's okay to sit there and wait and say this is just a bad time to be an investor. And I think right now is a pretty terrible time to be an investor in most things outside of energy.
So you think the Fed hasn't broken something systemic yet, but that they could do that soon?
I mean, they keep promising that they will. I mean, listen to Powell. He keeps saying we're going to cause a recession. And I think he's upset that the American economy is rather resilient, and he hasn't been able to break anything yet. And so he just keeps turning the knob until something breaks, and he's really proud of it. He keeps telling you he plans to break stuff, and if they take interest rates high enough, they will succeed. And so I just don't see any reason to be buying stuff. Especially anything that's even remotely tethered to what happens with financial assets and anything tied to interest rates. I mean, that's the sort of stuff that Powell's targeting, because he can't really target wages and job creation and unemployment. Like, those are out of his control. So he's going to, go after the stuff he can control, which is just raising interest rates.
Harris, what do you think is a common mistake that you've seen other investors make? Maybe the mistake that you yourself have made that you think, man, if people cannot do this, they have a much better chance of being successful?
Oh, don't buy junior mining stocks. Like, never touch those things. They're like kryptonite. They'll destroy your portfolio. But No, I think people just don't do enough work. They don't. I feel like people don't take enough of a step back from the world. And I talk to my dad. He's not a finance guy. He's just a real world guy, and say, Dad, this is what this company says they do. Does this make sense? It just seems like it's a good business to be in. How does this business get hurt? And I feel like way too many people look at a spreadsheet and they're just like, yep, it's a hockey stick, or it's 5 times earnings. That's cheap. I mean, 5 times earnings doesn't tell you if it's cheap or expensive. You got to figure out what it's going to look like in 2 or 3 years from now. And I feel like way too many people live in their little closed world of spreadsheets and analyst models, and they never go out into the real world and just say, like, does this make sense? Is this a good business? Like, what would it be worth if I bought 100% of it? I mean, Warren Buffett talks about it and everyone kind of nods, and then they go home and do the exact opposite.
Right. And there's a phenomenon where, talked about Sandridge, for example, just picking that. You bought that at $1 when it was trading at very distressed levels. It later went above $20. I feel like a lot of people, perhaps some people listening to this, bought Sandridge when it was at $20. How do you be someone who buys it at $1 instead of buying it at $20?
Well, I mean, buying it at $20 might not be a bad investment either, though it's gone down since then. No, you have to be really patient. I mean, look, I don't feel like it was particularly distressed when I bought it. They had $2 a share of cash, and they were profitable, and it traded for $1. You didn't have to make heroic assumptions. They had no debt. Like, I don't want to say the total worst case scenario, but likely realm of possibility was it was worth at least $2. And there was a pretty good chance it was worth more. And, I spoke to a lot of friends of mine in the energy sector, and they kept telling me how, Tom Ward was a bad CEO. He wasn't even the CEO anymore. Or, the Mississippi Lime's a terrible asset. Yeah, it's a terrible asset, whatever. Like, everyone told me what was wrong with it, but I already knew that, and it was in the price. And you get these situations a lot where something's really, really cheap, and everyone just has this preconceived notion about it. I think that the trick is just to sit there patiently and wait for something really easy. You wait for layups, you run a really concentrated portfolio, and you don't make mistakes. And it goes back to what I said a little bit ago. I mean, right now seems like a terrible time to buy most assets. So why are most people fully invested? It makes no sense. I mean, why did people go out there and buy unprofitable tech stocks 2 years ago? Like, I don't really know. They did it though. And, I think people just need to stop and think and buy the right things. I think the other mistake a lot of people make, and it's kind of crazy really, is they say, what's going to happen in the news tomorrow? Okay, this bank might fail. It might, succeed. What's going to happen to the non-farm payroll number? What's the CPI print? And they're going to buy and sell stocks and buy puts and hedge stuff. And for what reason? Just buy a good company with a good, strong tailwind and go to the beach. I mean, it's way more fun than staring at your screens, and you're probably going to make more money. Like, I still understand why all these people focus on all these things that are, so the CPI comes in wrong. It goes up. As stuff goes up, it goes down. Like, at the end of the day, does it matter to your company? Probably not. So, like, why do stuff? But I feel like people just want to play with their mouse all day. So I don't know. Yeah. This is a really simple business that, because people are trying to sell you stuff, they try to make it really hard. Buy really good companies at a fair-ish price, preferably a cheap price, but buy good companies with strong tailwinds and don't screw it up. And I feel like everyone just wants to focus on screwing stuff up.
Mm-hmm. And what if that very good company goes down in price? A lot of people say, oh, take your pain. The market is telling you something. Other people say, hey, if you liked it and it's getting cheaper, buy more.
You buy more. I mean, yeah. If they give you something for less than it's worth, you buy more. And if it gets even cheaper, you sell something else and you buy more. I mean, that's your only edge. I mean, remember the guy who bought oil at 120, got a margin call and sold it yesterday at 65. I mean, he's doing it all wrong. He should have been buying more.
Right. Well, Harris, it's been a great hearing your thoughts. You say that you should look for a layup. It sounds like one of the very few layups that you see right now is oil, and this oil stock that you mentioned. Is that accurate?
Yeah, I mean, I'm not going to say Journey Energy is a layup, but if you buy something for less than the PDP and management executes, I mean, it's going to be worth at least PDP. assuming the oil price doesn't collapse. And I don't think the oil price is going to collapse. And I think there's a pretty good chance the oil price goes higher and management buys more stuff really cheaply, or they'll just buy their own shares cheaply. So no, I think it's a great way to play oil, and it's one of my ways of playing oil.
Well, Harris, we'll leave it there. Thanks so much for sharing your view at a time where things are moving so fast. I also just want to say, you have a subscription product for hedge funds called KEDM, Kuppy's Event-Driven Monitor, which if you are into stocks that are, may not be part of the S&P 500 that experience, special events. Oh, the CEO is doing this. They have a special rights offering. If you're into that, you want to do the work, and I get it. So I know. I do recommend it, and it's very good. How could people find KEDM? And tell us a little bit more about KEDM.
Well, go to KEDM.com and take a free trial. We write some macro commentary, and then we're tracking over 25 event-driven strategies. All the opportunity in this world comes from some sort of inflection, and corporate events often lead to inflections, whether it's CEO change or privatizations, demutualization, spinoffs, like all these things. Did they change the trajectory of the business? You have a business that had a CEO and, he wasn't so good. And the new guy comes in, he might be worse, he might be better. And he might have a whole different way of looking at the business, but the company's going to go in a different direction. And as a result, a lot of value could be unlocked or maybe a lot of value destroyed. We're not telling you which, we're just telling you, hey, this just happened, go spend time and figure it out.
There we go. Kuppy, thanks so much. Thanks everyone for watching.
Hey, thanks for having me on.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.